Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Valuing Small Accounting Firms. Before we begin, we need to cover a few important items. First, please close all other programs you might have running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors, per NASBA. In order for you to receive your 1 CPE credit for today, you must complete 2 requirements. The first is that you participate in all 3 of the polling questions that we'll have throughout the presentation. And please note that GoToWebinar does monitor your participation in those polls. Next, you'll also need to complete an online evaluation. That will appear on your screen immediately after the end of the webinar, so be sure to not close your browser until after you've completed that survey. Once both of the requirements are met, you will receive your certificate by email within 10 business days. Now, in order to fully participate in the webinar, please take just a moment to familiarize yourself with the GoToWebinar control panel. You should see that on the right-hand side of your screen. There's an orange arrow near the top. You can use that to minimize the panel if you wish. During the presentation, all of the participants are muted, but you are encouraged to communicate with us by using the question box toward the bottom of the panel. Just type your question and click send, and we will do our best to answer all those questions if time permits later today. Now, finally, I'd like to remind you that Transition Advisors offers 2 free webinars each month. Our upcoming topics include buying out retiring partners, preparing your firm to go through M&A, the art of your deal, and a session about partnership agreements. You can learn more about those and register for them and see a complete list of our 2016 webinars on our website. Finally, you received a link in the reminder email today to download a copy of today's slides. I'm also sending that right now via the chat function, so if you didn't have a chance to download them to follow along, you can certainly do so now. All right, I would like to introduce our presenter for today. Joel Sinkin is the President of Transition Advisors. We thank you all for attending and hope you enjoy the webinar.
Well, hello everybody, and welcome to post-tax season 2016. I hope everything went well and smoothly as possible for this past busy season. Today we're going to be discussing one of the most popular topics of all the different CPEs that we teach, and that is how to value an accounting firm. If you're looking to slow down over the next 5 years, if you're looking to grow by merger or acquisition, this should be equally important to you, because it's no different when describing to someone who's thinking about selling or buying how one values an accounting firm. You know, I don't ever like to take a CPE class and turn it into an infomercial, but I do think it's important to know the background of the speaker so you understand their perspective and the benchmarks that were available to them. For the last 26 years, the only thing I've done is help accounting firms buy, sell, and merge with each other. I've been involved in excess of 800 closings of accounting firms. Keep in mind that's over 26 years, not over the last 6 weeks. But fortunately, you're listening to us in 2016, not 1990, when we were scratching ourselves along the place. Most of what we've learned by watching people make mistakes, us making mistakes, and trying not to make the same mistake twice. So hopefully you're going to get the value of all 26 of these years today in this initial presentation. The team is made up of quite a few of us. Little propaganda, Terry and I are the main partners, but you'll notice Bill Carlino and Mark Brzezinski, a lot of these people are very well known in the profession. We cover most of the country. But enough about us. Let's talk about the subject at hand. And let's start by a certain premise. And that is one that I always start with. And that is, if there's 50 things you need to know about a transaction, in this particular case, on how to value an accounting firm, the smartest person in the room is going to only think of 35. Now, we're not going to get you to 50 today. You know, one of the very cool aspects of an accounting firm, to me personally, is the uniqueness of each accounting firm. I could show you 4 accounting firms all doing the same relative volume with the same relative amount of partners and staff, and there may be nothing else in common about those firms. So today we're going to be able to give you the parameters that should guide you through the lion's share of the things you need to think about. But always remember there's certain aspects that will be unique to each deal, and hopefully common sense will get you through those. You know, I happen to write for the Journal of Accountancy. I don't know if any of you have read in the last 2 years. There's probably been about 16 articles we've written about valuing and structuring deals. And if you're a reader of Accounting Today and all these different magazines, there's not an issue that comes out that doesn't have a lot of conversation about the M&A activity. So what's going on out there? Why is the activity level so high? Well, part of it is economy-based. For example, in 2006 through 2008, accounting firms were growing like a weed organically. We had some of the greatest organic growth our profession's seen in those 3 years. In those 3 years, I had a lot of firms reaching out to us still interested in mergers and acquisitions, but mainly in increasing staff, increasing talent, not so much worrying about retiring partners because they had enough new business they were bringing in. But then 2009 came, and the economy took a big downward track. As a result of that, when organic growth is stymied, suddenly merger and acquisition growth becomes more attractive, and the market started to get very, very hot. Here we are in 2016, and none of us are sure. Are we going to be growth? Are we going to be shrinking? What's going on? Generally speaking, most firms had some decent organic growth in 2015, but obviously M&A has been a very hot topic because it's the fastest way to grow. But there are two main things that are really driving the M&A marketplace right now. The first one's niche development and the opportunities of cross-selling services. You see a lot of deals done in this country where one firm, for example, had a lot of relationships with law firms. Another firm did a lot of litigation support and forensic accounting and business valuations and clear opportunities of cross-selling. Maybe you have a lot of high net worth individuals and I have a wealth management, estate and trust department. So niches have been a big part of the merger activity and things of that nature. But by far and away, the driving factor in today's M&A world relates to the baby boomer generation. Here we are facing the largest exodus of talent we've ever faced in our profession. Some of the statistics the AICPA shares is very scary about the percentage of people that are going to be looking to reduce their time commitment over the next 5 years. And here we are at a time where we're losing some of the greatest talent we have at a time in our profession that finding quality staff is all but impossible. Heard someone say the other day, if you're a CPA and unemployed, you're either horrible or you don't want to work because we're at full employment right now. So how do we replace all these baby boomers? And this is a driving factor where so many firms have a succession element involved in their merger and acquisition plan. So this brings us to a very simple question that I get asked very frequently, and that is it a buyer or a seller's marketplace? And the answer isn't as black and white as it used to be. Until just a few years ago, it was always a very strong seller's marketplace. When someone says, I have $500,000 or $2 million of revenue and I'm ready to give it up, there's usually a pretty big audience who wants to make more money as compared to someone who's giving up an income stream. But these last few years have seen the market shift. So let's take a look at it in a little bit of detail to have an understanding of, is it a buyer or seller's marketplace? Let's start with location. There are certain parts of the country that tend to have a greater level of attractiveness. For example, the New York metropolitan area. I know my accent, you probably all think I'm from Atlanta, but I'm really from New York, so I have firsthand view of it. Very competitive marketplace. Southeast Florida not only has a local marketplace of interested in M&A, but there's a voluminous amount of firms not there that want to be, that creates an external market. So there are some places that the demand is just greater than others. Where it usually ties into is a density of population issue. For example, if I'm a small firm, I'm in the greater Washington, D.C. area, I'm in a very strong seller's marketplace. So if there's a dense population of CPA firms, and I have a small firm, generally speaking, it always has been and likely always will be a seller's marketplace. The reason for that is there's so many people that could acquire, for example, a $600,000 firm with little to no incremental increases in overhead. Nobody acquires a $20 million firm without huge incremental increases in overhead. So the ease of that acquisition, not the emotional ease, but the financial and professional ease of it, makes that a more doable situation for a lot of firms. So the pure number of it, for example, I'm speaking to you today from Nassau County, Long Island. Nassau County has 3,200 CPA firms. For every firm that's looking to give up revenue, there's dozens, if not hundreds, who would want to take that on if it's a small firm. But if I'm 3 hours outside of Boise, Idaho, I might be in some of the most beautiful country we have, but there might only be one accountant for every 4 zip codes. At that point in time, it's a buyer's marketplace. The reason that it's a buyer's marketplace is I've heard firms say I wouldn't acquire my competitor's practice because if they retired, I'm the only other person they would go to. So it's a supply-demand situation. If I'm in a densely populated part of the country and the supply of practices is limited, it's going to be a seller's marketplace. If I'm in a very sparsely populated, it's going to be the opposite. Now, values have come down, even for small firms. I remember in the early 90s, 2 times would be a number you'd see. 10 years ago, you'd see 1.5. We're not seeing those numbers anymore, but the demand is still great. Where the greatest change in the marketplace has occurred is tied into the size of the revenues of the seller. Let me give you an example. Look at a large marketplace like the greater Boston area. Boston has over 40 firms doing between $3 and $8 million. There's probably only 4 firms large enough that are based in Boston that aren't national firms that are big enough to take over an $8 million firm. Yet they have 40 some odd firms that are 3 to 8 million. So what happens is, as revenues go up, the pool of potential successor firms is less. So what happens is it becomes more of a buyer's marketplace. Think of the numbers. There's the top 100, which gets you to around 35, 36 million. The G400, the next category, gets you to around 8, 10 million. Then there's the other 44,500 accounting firms. So the larger the firm, the smaller the audience, and the more it is a buyer's marketplace. Now, there are always exceptions. Niches. If a firm has a lot of young talent or has a very attractive niche, that could increase its value. Just as if this firm had no real talent coming along and no real niches, it would decrease the value. But basically speaking, the smaller the firm, in the more densely populated part of the country, the greater the marketplace exists for them. Not always value, but the marketplace exists for them. And the larger the firm, the more likely it's a buyer's marketplace. What saves us all who are thinking about selling is at the end of the day, there's only 3 ways to grow in accounting. There's one client at a time, which in a good economy works well. There's developing a marketable niche to cross-sell additional services to pre-existing clients and develop new ones. But the fastest way to grow overnight is through a merger or an acquisition of another firm, which is one of the things that are always going to fuel this marketplace. Well, we're hitting our first polling question. It's really important you all answer these polling questions so you get credit for this. Nikki, let's get this first one done.
Okay, the first polling question is on your screen now. How many equity partners are in your firm? You see the options there, 1, 2 to 4, 5 to 9, 10 to 19, or 20 plus. As Joel mentioned, we'll have 3 polling questions today, and you do need to answer all 3 in order to get your CPE credit. Okay, I'll go ahead and close the poll. Share the results. Joel, 70% of the folks on the call have 1 equity partner, 25% are in that 2 to 4 range. And then we've got just a couple folks in 5 to 9 or 10 to 19.
Excellent. Well, it's funny how today at 2 o'clock Eastern time we'll be teaching a class on how to value larger firms. I'm glad that most of the people here are in the smaller firm categories because we're trying to make this as specific as we can to your world. In order to get to the big question everybody always has, whenever I teach a class on how to value an accounting firm, there are 3 main questions people raise to me. The first one is, what is the multiple? The second one is, what is the multiple? And the third one is, what is the multiple? And I assure you we're going to talk about what is the multiple very specifically today. But before we get there, what we really need to understand is the alternative deal structures, because how you structure your succession deal has a lot to do at the end of the day with how certain things are going to be valued. There are 5 main different ways that we take a small firm into a succession plan. The first one is the easiest one to describe. It's a straight sale. Now, that doesn't hopefully mean that I'm selling you my practice and I'm going to Boca Raton tomorrow. What hopefully it means is I'm not looking to stay on full-time. I'm not looking to stay on in an equity role, but I am going to be available to do a proper transition. So a straight sale usually means I'm immediately reducing my time commitment and I'm selling you my practice outright. That's probably the second most often deal that we do, maybe the third, but it's a popular deal. It's not one I always recommend. I'd rather have a longer transition, but I get the realities of certain situations that create the demand for a straight sale. Probably the least often one we do is a buy-in to a buyout. Let me give you an example of how that works. Let's say Nikki had an $800,000 practice and I had a $200,000 practice. Well, when we merged together, the new firm's $1 million. For me to have been a 50% equity partner in the firm, I would have needed $500,000 in revenue, but I only came in day one with $200,000. So initially, I acquired $300,000 in equity from Nikki, typically with a payout period, not by writing a check. And now we're 50-50 partners. And maybe 3 years later, Nikki retires, and I buy out the balance. A buy-in to a buyout. That's where typically this buyer will buy a percentage of equity interest into the firm using a combination of their book of business and payments that leads to an ultimate buyout. There are times where the successor firm won't even include their clients. For example, last year in a deal that we did in Texas, I had the seller say, you know what, nothing for nothing, but I don't want the liability and exposure of your clients to the buyer. So why don't you buy in an equity interest into my firm, keep your practice separate, and then buy me out 2 years later? A buy-in to a buyout. A merger to a buyout is a very similar situation, except there wasn't an initial buy-in. That's probably the second most often deal we do. So if we go back to the illustration I used moments ago, Nikki's $800,000, I'm $200,000. The new firm's $1 million. I'm a 20% equity partner, and Nikki's an 80% equity partner. And there's all sorts of pretty cool hybrids with each of these types of deals. I'll give you an example. Maybe what we do is in this merger to a buyout, that on the first $1 million, I'm a 20% equity partner because I only had the 200. But on the excess of $1 million, we're equal partners. So maybe we're going to share in the growth equally going forward. So let's say 5 years from now, I retire, and or Nikki retires, and the firm's doing $1.5 million. Well, on the first $1 million, I had to buy out 80% of that. On the second $500,000, I only had to buy out 50% of that. So that's a merger to a buyout. What's kind of interesting and has been happening a lot is what I call a carve-out sale. A carve-out sale can be for many different reasons. Here's a couple of examples of them. Last year in the Chicago area, we had a firm that had a very good practice and also had a wealth management niche. The gentleman who owned the practices loved the wealth management, really was burnt out on the accounting side, the deadlines and everything else. But he always felt that the wealth management was a springboard, the accounting firm was a springboard to his wealth management stuff. As a result of that, he became interested in the idea, though, of is there a way he could still have that springboard but not still have the accounting firm? Well, we ended up selling his practice to a larger firm, not crazy large, but somewhat larger, who had a lot of high net worth individuals, who wasn't doing NA Wealth Management. And here's what the deal looked like. They said to this gentleman, Jay, we're going to acquire your accounting and traditional accounting and tax practice, and we're going to pay you X dollars for it, and we're going to sign a non-compete so that we won't compete with you in the wealth management side, but Mr. Seller, you have to sign a non-compete on the compliance side. We sent out a letter to the clients from the seller saying, hey, I'm pleased to announce that I've merged with John and Jane Doe, that I have found it impossible to stay on top of the day-to-day changes in the stock market, as well as the constant changing of tax laws, etc. So by merging with Jane and John Doe, we'll be able to have them pay more attention to your accounting and tax compliance traditional needs, while I focus more and exclusively on the wealth management. We held it out as a merger of specialties and niches. Matter of fact, the buyer, who was licensed, is now referring his clients to the seller for wealth management and participating in that because they're both licensed. And the seller, every time the seller gets a new client for the wealth management, refers it to the accounting firm where appropriate. So that's a carve-out sale. I've done a carve-out sale where someone kept the regular practice and sold the niche, or kept the niche and sold the regular practice. Another type of call-out sale that we're seeing every now and then, I have one going on right now in New York City. Had a firm doing $1 million. But there was $75,000 worth of clients that the owner just really enjoyed and had a personal relationship with. They were not by far the best paying clients, quite the opposite. They were the worst paying clients. Some of them were relatives. But he didn't want to give those clients up right away. So what we did was we acquired $900,000 of his practice day one. We said to him, hey, come into our office. You operate your $100,000 out of our office, so over the next couple of years, they'll get used to coming here. We'll meet them and greet them. This way, you'll also be here to be the glue that cements the relationship in the $900,000 that you've just sold to me. And you run your 100. You only pay us incremental increases in overhead, if any, for keeping you here. And we get the first right of refusal to take over that last batch of $100,000 at a later date. So what happened was, between the purchase price he got on the $900,000 and the fact that his $100,000 he kept, his gross is practically going to be his net, his income didn't even fall that much, and now he's going to be working a couple of days a month. So it's kind of an interesting. So a cull-out sale could be culling out a portion of your practice based on a location, a satellite office, based on a niche, to sell or to retain it. It could be just a stepping stone to succession as well. But by far and away, the most frequent deal that we've done and do is something we created about 15 years ago called a two-stage deal. Let me tell you what it's based on. Most of you on this phone are small practitioners. And I don't want this to sound like a negative. I mean it as the greatest compliment possible. But why do you have your clients? Let me tell you that 99% of your clients have no idea if you're competent or incompetent, because if they knew that much to measure your technical skills, why on earth aren't they doing the work themselves then? Unless you're doing an audit for them, which they couldn't do for themselves, they probably have, and you do the work because they don't know how to do it. So let's go back to the question. Why do you have your clients? It's because of you. It's their unwavering trust and belief in you. It's the greatest compliment because in a way it's blind faith. So these are why small practices are partner loyal. But because they're partner loyal, not brand loyal, we also should recognize it takes a longer period of time to transition those clients. And what's mitigating that further is how the frequency that we interact with our clients on a personal, physical basis, being in the same room with them, is so diminished. In 1990, when I first started, I had a lot of the small practices went out every month or quarter to see their client. Heck, a lot of them did the work there. They wrote the check, the client signed, and they left. Welcome to 2016, where if you're not on the cloud, you're probably going to be, where most of you are communicating with your clients more than you ever have, but it's through email, the cloud, phone, Skype. But according to Accounting Today, almost 90% of accounting firm clients, they're only in the same room with their owner, who's managing them, once a year. Now, that means over the course of the next 3 years, it sounds like an eternity, and I should be able to transition the relationships easily. 3 years is really only 3 visits. 5 years, 5 visits. 2 years, 2 visits. And we've already established that these clients are partner loyal. So it takes more than one effort. And by the way, I have a computer glitch that it just wants to change its own page on its own, but we'll get past it. So at any rate, it takes time to transition these things. So a 2-stage deal was designed to help create a situation where, as a seller, I can retain reasonable autonomy, control, and income, yet at the same time conduct a transition. See, when I first started preaching about why do you have your clients and how long it takes, everybody agreed with me, but nobody did a transition because nobody wanted the accountability of giving up control of their practice. They didn't want to give up income or control, so they put off it. The 2-stage deal answers that. So here's how a 2-stage deal would work. For example, at the beginning of stage 1, the way we started is we calculate the owner's net and how much labor they use. So let's take an example. Let's say I'm a sole practitioner doing $500,000 a year, and let's say I show you, including perks, benefits, and the kid's cell phone, that I'm netting 40%. And let's say I'm netting 40% using 2,400 hours of senior time, 2,400 hours of paraprofessional time, and 1,000 hours of per diem time. So I've established on my clients, which let's say on the contract that I would prepare would be Exhibit A, that I'm netting 40% by using Exhibit B, this much labor. In a multi-partner firm where there's many owners, instead of focusing on how much labor they use, I might focus on chargeable hours, but most of you are smaller firms, so we would be focusing more on the support you're giving. And then the next question to the seller would be, how many more years do you want to work full-time before you slow down? The right question isn't when do you want to retire. Right? I might want to work 10 more years, but I might only want to work 3 more years full-time. So let's say that now we've established that my net is 40%, that I have 3,500 hours of senior time and 2,500 hours of para time that I use, not including my own labor, and I want to work 3 more years full-time. We've established the criterion for stage 1. So now what we say to the seller is, I'm the buyer, Mr. Seller, and I'm going to take over all of the operating expenses, the rent, the software, everything. Right now, you're making 40% of what comes in, so I'm going to pay your entity under the consulting agreement 40% of what comes in. Now, the reason I'm paying it to the seller's entity is this way the entity could continue to pay the car lease and the medical insurance and have all the tax benefits of ownership that they had right now, feeding retirement plans, etc. And from the buyer or successor firms, I'm getting a current deduction. So I say to the seller, look, I'm not worried about how much time you put in. You're not a clock-punching employee because that doesn't affect me as the successor firm. See, if the seller puts in 2,500 hours or 2,000 hours, that doesn't impact the successor firm. What impacts the successor firm is the amount of labor they have to offer. So as long as you don't need more labor than you used in the past, then I'm going to continue to keep you whole in income by taking over all the overhead and paying you your 40%, which is in this case what we said the seller was making. So from the seller's perspective in stage 1, I come and go as I see fit. I have all this additional backup and support. Most of the time, the successor firm takes over a lot of the admin and billing and collections and IT, so I actually get to work a little bit less. It's kind of like I got a built-in practice continuation agreement, but it's on steroids because, God forbid, something happens to me, we accelerate to stage 2. It also gives me protection on the downside. Let me explain what I mean by that. As a $500,000 sole practitioner, if I lose a $50,000 a year client, I probably lose $50,000 of income because everything else is fixed. Now I'm going to lose 40% of that. So I'm actually usually putting in less time and effort. I have all this backup and support. I'm doing a great transition for these 3 years, getting my clients acclimated to my successor and vice versa, which is going to mean I have a better retention rate post-closing, which is going to mean buyer and seller make more money. So from the seller's perspective, it's a home run. They're still master of their own domain, same income, but have backup and support and succession. Why would the buyer do it? Well, from the buyer's perspective, in a classic situation, I'm going to move you into my office, so I'm going to save on rent. Let's use that example before. Maybe you had a secretary as a labor. I don't need two of them. Maybe I don't. Most of the time, we'll keep the professional staff, but sometimes some of the clerical staff will create overhead synergies. So usually between labor, rent, software, malpractice insurance, there's a lot of synergies that created. Those usually accrue to the buyer. Matter of fact, just last week in a deal in Philadelphia area, I had a seller call me up and say, the buyer is saving $75,000 between labor and rent. If you add software and malpractice, it's closer to $100,000. I should be getting a piece of that. And I yelled at the seller. I said to him, David, you got everything you asked for. Backup support, succession, autonomy, control, income. The fact that they're making some money is why they're doing the deal. Don't take away their reward. Everybody wins in this case. This is, if I'm going to take on all the overhead and I'm going to take on all the liability and exposure and I'm still doing the quality control, of course, and I'm going to meet all your clients and spend time, of course there has to be something in it for me. But fortunately, it's not coming from the seller. So in a two-stage deal, the buyer gets the synergies, the seller gets the whole in income, and then we look at stage two. Stage two is the buyout. See, I can't keep you whole in income and pay you for your equity at the same time. So by deferring the purchase price during stage one, I can help the seller maximize their income during the stage one and maximize their buyout. So typically when you do a two-stage deal, you'll have language that stage one terminates and stage two commences on the first of the following events: a back date, a health issue comes up, or the seller gives 90 days notice that they've decided they want to slow down. If we're doing a deal that involves a retention period, which most deals do, keep in mind the retention period doesn't start till stage two starts. Stage one, the seller's still running the practice, still chief cook, bottle washer. The retention period always begins on the onset of when the buyer takes control. Now, that doesn't mean the seller doesn't usually stay on in a part-time role, and usually they'll stay on and we'll pay them a third of whatever we bill them out for. So we're going to triple labor. We were going to pay someone else a third of what they're billed out for. Why not pay the prior owner? So most of the time, even when stage two occurs, the seller stays on in a part-time role. Also, a lot of times we give the seller a great new business incentive program where, hey, if you develop a new client during stage one or stage two and bring it into the firm, we're going to reward you for it. So a two-stage deal gives a huge amount of security, autonomy, control, everything for the seller, overhead synergies for the buyer, and knowing that they're going to have the reward of being the successor of this firm within a defined time frame. You don't do a two-stage deal without defined time frames. You need it so you know when you have to enact proper transitions anyway. So this is a very frequent deal structure, a two-stage deal. Let's do our second polling question, and then let's answer the question, what's the multiple?
Okay, the second polling question is on your screen now. In the next 5 years, what is your firm most likely to do? Sell, acquire a smaller firm, merge into a larger firm, or not sure? We'll give everyone about 10 more seconds to answer the question. This is the second of 3, and you do have to answer all 3 in order to get the CPE credit today. Okay, the results are on the screen. Joel, 39% say they aren't sure. 27% say acquire a small firm. And then 17% each for the sell or merge into a larger firm.
All right, so kind of a third are looking for succession, a third looking for growth, and a third not sure. That's kind of okay. So that's not that untypical for where we are. So let's get to the big one. And the big one is, how do we value an accounting firm, and what is the multiple? Keep in mind that the multiple is the effect. What we want to do is focus on the cause. There are 5 main variables I look at when valuing an accounting firm. If any of you purchased recently the third book that we wrote on, which is heavily about how to value an accounting firm, and I talked about 10 variables. Forgive me, I was paid by the page. I could really have done a Reader's Digest version of 5 variables, but let me get away with it. So let's talk in no particular order, except for the last one, on the first variable, and that one is cash up front, if any. You know, I will tell you, if you're a seller, this is not going to be welcome news to you. In over 800 closings of accounting firms, I've never been in a deal where someone just wrote you a check and you walked away and you were paid. All right? Cash up front is typically in our deals a very nominal number. The range for us has been from 0 to 20%. I've had way more at 0 than I've had at 20%. If I was to say a typical, I probably would guess the typical to be 10% up front. Now remember, in a 2-stage deal, the upfront money didn't occur till stage 2. That's when the benefit of the practice shifts. Now there are other mitigating factors besides how deep my pocketbook is that will impact cash up front. For example, time of year. I had someone call me last week. They were a small firm doing $600,000 and some odd and told me flat out they've already billed out 2/3 of that revenue. So if I'm going to take over that firm July 1, I'm going to probably have trouble just covering the overhead of the practice for the next 8 months before I get back into cash flow. So it's very hard to close a practice June 1st if it's a heavy tax season oriented practice. Forgive my computer, it won't stop jumping. You know, I would have gotten a bigger down payment in January than I'm going to get in July. So the time of year could impact it because of the deal's cash flow. Also, what a lot of people don't realize is the treatment of accounts receivable can impact it. So if my receivables kind of remind you of Charlie Manson, and I'm 6 months and 9 months late in collecting money, and as the seller, I said to the buyer, the first dollars that come in have to go to me. Well, heck, that you're going to ask me to fund the operation of the practice for 6 months and give you money up front? I don't think so. So the treatment of the AR could have a big impact on whether or not you're getting a down payment. I've even seen deals where you didn't get a down payment and you actually got a payout period on your receivables because they were that bad. The bottom line is the buyer's got to recover their investment. They're not going to do a deal to lose money. You're on this phone, over 75 practitioners. I'm sure thousands of people have been advised by this group about buying a business. You've never told one of your clients, buy this business, you're going to lose money for 3 years, it's a great deal. Well, we can't tell that to your buyer. So at the end of the day, it has to make sense. So cash up front, if any, is variable number 1. Variable number 2, to a lot of people, is the most important part, and that's the retention clause or the guarantee. What we're referring to here is for how long after closing, if a client dies, goes out of business, or if the fee goes up, how long will the seller and buyer still be adjusting the purchase price based on client retention and fees done? And in 2016, where people are worried about the longevity of a client, the retention period has become even more significant of something on someone's radar. So let's describe the 3 most frequent deals done in the country, and let's analyze them from a retention perspective. I will tell you that on internal sales and on some very large deals, I've had guaranteed minimum or guaranteed purchase prices. So when I'm retiring a partner, or I'm a $20 million firm where the $100+ million successor firm perceives the clients as brand loyal. But on small deals, I personally have not been involved in any that did not have a retention period. So they were either 1 year, meaning at the end of the first year, the purchase price locks based on what we are at the end of the year. They've been 2 years, which can work many different ways. It could be an average of the first 2 years. It could be based on year 2 only. It could be based on the repetitive business that is done in year 2 only. So there's a whole bunch of ways, but is it a 2-year retention period or 1-year retention period? Or as probably 80% of our small firms are, a collection deal or an earn-out deal. This is where a seller is paid based on a percentage of revenue. For example, if you were to get 1.2 times over 6 years, you'd get 20% of gross collections for 6 years. So what's interesting and very counterintuitive is, what's the best of those 3 deals, 1-year guarantee, 2-year guarantee, or collection deal? What's the best one for the buyer, and what's the best one for the seller? Well, we've done a review of almost 100 different deals that closed years ago for a new study that we're doing on behalf of the AICPA. And here's what we found. The worst deal, counterintuitively, for the seller was the 1-year guarantee deal. Let me tell you what we found. What we found was that buyers, because they got very paranoid that at the end of the first year, Moses was going to part the Red Sea and take all the clients away, that number one, they offered a much lower value or multiple because of the risk inherent in having such a short retention agreement. The other thing we found that they did was they shook the tree real hard during that first year. They weren't going to lose a client in month 15 that they could have lost in month 5. So what happened was buyers offered a much lower valuation, were much less patient in the transition. So sellers ended up getting the purchase price locked at a lower multiple at the lowest point in time of the practice that was going to generate. What worked out to be the best deal for the buyer on these smaller acquisitions was the 2-year guarantee. And here's what our research has determined as to why. Let's say that I was going to buy Gretchen's practice today. If I do the work in 2017, if they come back in 2018, they're mine. They've gone through the change. They've felt comfortable enough to return in year 2. Year 2 is always the greatest measurement of success of a merger or acquisition because people went through the change and elected to return. So what a lot of buyers did by having a 2-year guarantee was lock the purchase price at the end of year 2, where most of the risk has been removed, and stop the seller from participating in the growth of the practice that traditionally would happen in subsequent years. The best deal for the seller, shockingly enough, worked out to be the collection deal. When the buyer had less risk, their average valuation was much higher. So they were paying a higher value. And because if you kept the client 2 years, the likelihood in years 3, 4, 5, and 6 is much greater for fee increases, special projects, etc., than attrition, the seller was participating in the growth and the growth of the practice. So because the buyer didn't have a risk to push people out the door, was more patient, what we found was most of the time, the seller got a higher multiple from a buyer who was more patient in the transition, and the seller participated in those increases in fees. And I think that's fair. It's very hard to say to a seller, hey, I lost this client, they went out of business, I'm not going to pay you. Oh, this client went from a review to an audit, but you're not getting the extra. Of course they should. They're participating on the downside. They should participate on the upside. I will tell you, as I stated earlier, the lion's share of the deals we do have been earn-out or collection deals. The fixed deals we have done where there was no purchase price were very, very rare and almost never on an external sale. Sometimes you do see deals with what I'd call a limited guarantee. An example of that might be it's a 2-year guarantee. But if in year 3 I lose that client to another local accountant, I get no adjustment. But if in year 3 that client died, went out of business, relocated, sold, heck, you'd have lost them too. That's a limited guarantee. You'd get an adjustment. Okay? And a limited guarantee and an economy clause. The economy clause, really what I just described. A limited guarantee is a 2-year deal. So the first variable in valuing an accounting firm is cash up front, if any. The second one is the duration of the retention period. I think the third one in many ways is the least understood because I hear people talk about profit and billing rates who clearly are missing the boat. When I talk about profitability of a deal, I'm talking about the profitability for the successor firm. I'm not talking about profitability of the seller. And let me show you why. Let's say 5 years ago I had a $300,000 practice. I operated out of my home. My wife, Kathy, answered the phone. My net was what, 85%? Then we were tired of people knocking on the door, so I took an office. Kat didn't want to come with me. I hired an office manager. Now I'm netting 40%. At which point in time was my practice worth more to you? It's irrelevant. If you could absorb my practice with no incremental increases in overhead, it's very profitable. If I tell you got to keep my lease and you got to keep my secretary and I want goodwill, and even though you got to deduct it over 15 years and you're paying me over 5, you're going to get beat up. Obviously, that does what? It reduces the profitability of the deal, and a buyer's not going to do a deal to lose money. It's why a lot of times a seller will say, I got to have goodwill. Fine. But unless your payout's 15 years, you got to know the buyer's going to reduce the offer by that. Perhaps if you put a lot of it in consulting, and right now your entity's paying your car lease and your medical insurance and feeding retirement plans, you run a lot of that money through that same type of consulting agreement to your entity. Yes, what comes out is taxed at a higher rate, but you have the use of pre-tax dollars, and you're going to get a higher valuation. So profitability is the buyer's profitability. And the same thing with billing rates. I remember 2 years ago in our Florida office, we had an unusual practice in that it was 2 owners and a whole bunch of bookkeepers. The owners did all the heavy lifting. And they were $1 million firm, and they were selling to a $6-7 million firm in Southeast Florida. And when they came to the due diligence, the buyer called me up and said, Joe, we got a problem. These 2 gentlemen are wonderful gentlemen. I like their practice, but they're only getting $200 an hour for partner time. We get $300. I don't see how we can get past it. I said to him, not who's holding the client's hands, but based on you doing the due diligence, who's going to do the work that these 2 partners are doing? They remember, the successor firm had partners, managers, seniors, juniors. The seller had 2 owners and bookkeepers. Well, the buyer said to me, Joel, 90% of the work these 2 owners are doing would be senior level work by me. I said, okay, what's your senior's billing rate? They said $150 an hour. I said, I guess they're getting $200 now. Even the billing rate has to be understood better. What time and effort and leverage will the successor firm have? Will I be able to push some of the work down to another level? Is my technology sufficient, stronger, that will take me less time and effort? It could be the opposite. Maybe my quality control process is more robust than yours, and it's going to take me more time and effort to derive the fees. So the seller's profitability and the seller's billing rate is a good starting point. But what it all comes down to is what your anticipated billing rate and your anticipated profitability is going to be as a buyer. The 4th variable is the duration of the payout period. Most firms under $1 million, $2 million, the payout period's 4 to 7 years, with most of them 5 and 6 years. I mean, I've seen very rarely on some real small deals of 3 years. I've seen payout periods as long as 10, but most of them are 4 to 7 years. So variable number 1 is cash up front, if any. Variable number 2 is the duration of the retention period. Variable number 3 is the profitability of the deal for the buyer. Variable number 4 is the duration of the payout period. Number 5 is the multiple, because the multiple is the effect. Everything else is the cause. Think of a basic rule of thumb. Less money up front, longer payout and retention periods, more profitably structured, the higher the multiple. Ask me to pay you faster with more money up front, I'm going to pay you that much less. Let's take that out. Let's say that I had a $300,000 practice, and all of you on the phone could absorb it with no incremental increases in overhead. If I said, pay me 15% of collections for 10 years with no cash down, structured as a consulting agreement, would you do the deal? I know as a buyer, I would. I know the multiple is 1.5 times, which is very, very, very high in this country in 2016. But I have no risk. Heck, if I raise the fees 7.5% in years 1 and 2, I've basically paid for the whole acquisition. If I lose a client after 5 years, I collected 500% and paid 0.75. As I said, I do that deal in a heartbeat. Now the same seller says, Joel, I want to be paid out over 5 years. Whatever you do in the second year locks the purchase price. I want 10% up front, and I want goodwill. Depending on where you are in this country, you're looking at between 0.75 and 1.1. Now the same seller says, I want all cash at closing. I wouldn't touch the deal at 50 cents on the dollar at all. So here's the same practice. I wouldn't pay 0.5, but I would pay 1.5 times. It's not the multiple. It's the whole package that you have to look at. And I know some of you are sitting there saying, well, the 15% for 10 years, present value makes that differently. No, not necessarily. See, I hate present value, because I've always struggled with it. I mean, I get it, but I don't get it. That's a long story. But present value doesn't apply, because if you bought my $300,000 practice and grew it, and I was getting paid on that growth, that fee increases could be better than any interest factor, so present value doesn't apply. It's the structure. That's also why a lot of times people want to say to me, well, Joel, a tax client can't be worth the same thing as a business client. Then I ask them, on a pure hourly basis, what do you make more money doing, tax work or the traditional accounting? Oh, tax work. On a collection basis, what do you collect easier? Oh, the tax work. On an exposure basis, what do you have less on? Oh, the tax work. So then why do you want to pay less for tax? I hear two things. A, it comes at a terrible time of year. My answer is get over it. You chose to be an accountant, your fault. Second reason they'll say is because we have a higher attrition factor on them. Ah, correct. But that's a retention tool. If I'm paying you 20% of collections for 5 years, it's figured in. If I lose a 1040 client, I stop paying. But if it's a 1-year guarantee, and it's a whole bunch of 1040 clients, I'm going to greatly hurt that value because one visit doesn't make loyalty. So when valuing your firm for an external sale, you have to look at the whole package. Cash up front, retention, tax structures, all these things at once. You can't negotiate one variable at a time, or you'll just kill yourselves in negotiations. Put the whole thing on the table. Make sure the seller's well paid for their years of sweat equity, but the buyer's making more money. Now we're going to talk a little bit on some of these other matters. Real quickly, small deals, furniture, fixtures, and equipment's usually a throw-in. Be careful that you don't sign a long-term lease if you're looking to sell in the next few years. Nobody wants your location. It just diminishes things. What will make your firm more attractive is having good young staff. Also, some people during the retention period want to negotiate. Does the seller get fee increases going forward based on services rendered in the past? I'd say 100% of the time. Do they get participate in the fee increases for new services? Most of the time, if not at least a percentage of it. Do they get any, if a client refers a client, do they get something? Almost never. I mean, if I've owned this practice for 2 years and I'm doing a great job and all of a sudden I get a referral, that's the fruit of my labor. But I would give every seller a new business incentive clause. So before we talk about how to buy out partners and wrap this whole thing up in 2 minutes after, let's do our last polling question, then I'm going to blow right through the last few minutes.
Okay, the final polling question's on the screen now. What issues do you see affecting your practice most next year? Your choices are succession, admitting new partners, client retention, or all of the above. I'll keep it open for about 10 more seconds. This is the third and final polling question of the day. Okay, looks like we have nearly everyone having voted. I'll share the results. 32% say all of the above, 30% succession, 24% client retention, and the remaining 14% admitting new partners or shareholders.
For those who want more information on these topics, make sure you go and look at some of the upcoming webinars we'll be doing. We're talking about admitting partners, keys to client retention, when to start to plan your succession. Today I'm trying to stay focused on value. Let's do that. Also, let me address a question that came in on the chat line. Someone who was offered a good job and as a result was thinking of selling their practice outright to a small firm. They asked, what's a reasonable time frame for a straight sale once the buyer is found? 60 to 90 days. I mean, what you should do is share some generic information, get an offer. If the offer makes sense, do due diligence, draft an agreement. It shouldn't be brain surgery. I mean, the best way you can move that along, have your information as a seller ready to share with the buyer without the names of your clients or anything. Make sure they have a good understanding of what it's about, and read some of these articles that you'll be getting with your as a follow-up to this about how to value a firm. And shouldn't take more than, actually 30 days, but let's say 30 to 60 days is probably the typical average. A couple quick and last-minute things, because some of you are multi-partner firms and you're buying out partners. First of all, always remember, when I'm buying out a partner, I'm going to pay less than I would in the street value. I mean, an inside sale always goes for less because of sweat equity. I mean, maybe you and I got together, we were $1 million, now we're $2 million. Didn't I help and didn't you help? What bothers me is there's no retention period. If I'm a 3-partner firm and we each have our own book of business, and you have no relationship with my clients and I have none with yours, having no retention period is awful dangerous because you're buying out someone fixed. But if you have at least a notice requirement, for example, a 2 or 3 year requirement before you retire, that you give notice and you execute a good transition plan during those 2 or 3 years so that those clients are going to be transitioned, then you can get away with no retention period. But you need buyouts for death, disability. One of the keys is partners, everybody needs to make more money. This goes back to something I said a little while ago, that nobody buys a business to lose money. You've never recommended it. What's changed a lot in the internal world of buying out partners is it used to almost always be done exclusively based on buying you out on a multiple times your equity interest in the firm. But now many firms have switched. I'm sorry for this constant movement here. Many firms have switched to go to a buyout based on compensation. For example, they'll take an average of your last 5 years' income, multiply it by something between 2 and 3, and pay it over 10 years on a K1. So I get asked, should the buyout be based on compensation or should it be based on equity? Well, you know, a partnership agreement shouldn't be brain surgery because I should be prepared to pay you as I want to be paid. But here's a litmus test I want to give you to make sure your deal works. Let's say that I'm a partner in a firm, I'm making $300,000. Let's say to replace my labor cost $100,000. Now there's $200,000 left for the firm. How much of that do I get as the retiring partner, and how much of that do you get, and for how long? Because based on that concept, I'm being paid for my years of sweat equity, you're making more money. So you always have to use that litmus test. How much does the partner make? Reduce from that the cost of their buyout. Reduce from that the cost of replacing their labor. There better be a positive number. If there is, you can make a deal work. So that's kind of your litmus test. Now, if you look at the statistics, you'll see that the smaller the firm, the more likely, hey, we didn't even have an ownership agreement, but those who do most likely are looking at a buyout based on ownership times revenues, all right? And to be more specific than that, these are all from the AICPA 2012 Succession Survey. For those that did use a multiple of equity interest, as you could see, the smaller the firm, under $500,000, 17% got 50 cents on the dollar, 17 got 80 cents on the dollar, 2/3 got one time. And as you go up in revenue, you'll see those numbers shrink even further. You know, very, very rare will you ever see anybody in these charts getting more than one time. Sometimes that could be deceiving too, because maybe it's one time, and what they're doing is adding in your capital account, which usually isn't part of the purchase price. It's actually reimbursing you for capital. For those that are using a multiple of compensation, you'll see that almost nobody in the $500,000 range and smaller did use that. In the next category, you'll see some at 1 year, some at 2 times. So these are the different formulas, again, that the statistics have been showing. What I could basically sum up everything is, whether you're selling to your partner or however, got to make sure it's a classic win-win. They're getting a benefit, you're getting a benefit. But if I'm looking at an external sale, the most important things in deciding who to sell to are the 4 C's. Chemistry. If I don't want to eat lunch with you, I shouldn't do a deal with you. Continuity. My clients like the way my ship's sailing. You're not going to completely change it so that they feel everything's different. My culture. My clients and staff are used to my culture. Does your culture match it well enough? And the C that not enough people think about, capacity. Do you have the time, capacity-wise, and skill set to take over the roles of the people that are slowing down? Focus on those 4 C's. Don't worry about how deep someone's pockets or great their technical skills. What matters are the 4 C's. That's what's going to make a deal work or not deal. Make sure everybody wins. Don't negotiate one thing at a time. If you want to increase the value in your firm, get your metrics up, embrace technology, avoid leases, have some good talent. If you'd like some more detailed information, I work very closely with the AICPA, especially the PCPS division. This link will take you right to their spot where they have an incredible amount of resources on all sorts of topics: how to choose a successor, when to slow down, how to value it, what to look at, due diligence, keys to client retention. Help yourself, it's free. And on our website, under the resource section, there's probably 60 articles on all different topics relating to succession, mergers, valuations. Jump on in, read them all. There's no codes to sign in on any of it. It's all there, free for you to look at. If you have any questions, don't hesitate to email me directly. and we'll do the best we can. Nikki, is there any wrap-up business we need to do or any additional questions?
Well, we do have several questions that came in at the last minute, but I think we should respect time. We have to end the webinar in order for everyone to be able to participate in the survey. And so we'll go ahead and wrap it up here, but Joel will answer all of those questions. I'll make sure he gets them and he can reach out to you individually, or we could include an answer for the benefit of everyone in the follow-up email that we send out within the next week or so.
If you have the question in their email address, I'll send them directly a response between today and tomorrow.
Perfect. Thanks so much. So all of those questions that came in, I'll be sure that Joel gets those and he'll be in touch with you very soon. As I mentioned, we will be closing the webinar now. Once we do, the survey will pop up. Please take just a moment to complete that. And then within 10 business days, you'll receive an email from me with your CPE certificate. If you have any questions in the meantime, if you would like a PDF of any of the articles, or any of the slides that were mentioned, just shoot me an email. You can reply to the reminders that you received or to the follow-up email you'll receive in about an hour. Thank you so much, Joel. Thank you, everyone, for attending, and we hope you'll join us on another future webinar.
Thank you, Nikki. Everybody have a great day.